Are you wondering what the benefits of determining continuing values are? In this video, we look at how continuing values help us separate the known from the unknown. How can we determine a measure for what we do not know? Our economic profit model is value of equity equals the book value of equity plus the present value of abnormal operating income. And the present value of abnormal operating income equals abnormal operating income in year one divided by the weighted average cost of capital plus abnormal operating income in year two divided by the weighted average cost of capital squared, and so on for eternity. The present value of abnormal operating income is calculated by discounting the expected future abnormal operating income of a firm for eternity by the required rate of return for operations. It is only practical to forecast abnormal operating income for a relatively short period of time, for just a few years. This is called the forecast horizon. How far we can see into the future will vary for different firms, but there will always be a limit, a horizon. We can conceive the value of the equity in a firm to be the book value of equity plus abnormal operating income in year one divided by the weighted average cost of capital, the cost of capital for operations, plus abnormal operating income in year two divided by the weighted average cost of capital squared, and so on to year t plus a continuing value in year t divided by the weighted average cost of capital to the power t. Year t is the forecast horizon, and the continuing value in year t is the value of the firm's equity at the end of the forecast horizon. Does this simply mean we have transferred our problem of valuing an earnings stream into eternity, as at the present date, into a problem of valuing an earnings stream into eternity as at a future date, that is, in period t? The answer to this question is, well, yes. But what we have achieved by doing this is to clearly separate what we can reasonably estimate based on information we can critically analyse, that is the current book value of equity and abnormal operating income in year one, abnormal operating income in year two, through to abnormal operating income in year t, from what we cannot, that is continuing value in year t. It is most effective to simply make some broad assumptions beyond those periods where we can forecast abnormal operating income. In the video formulas for continuing values, we look at the formulas for continuing value we have incorporated into the spreadsheets. For further information on how to determine continuing values in practice, go back to Chapter 7, Section 7.2 in the study guide, and also review how to predict the future to eternity weekly questions. Also answer, write and rate questions on how to predict the future to eternity in Peerwise.